Hi there. The market has been volatile lately, and I wanted to check in with a little explanation of what's going on. After a hot start to the year, the market's been choppy now for about several months. And as you know, the Federal Reserve has been aggressively raising interest rates to try and defeat inflation. Inflation is not fun, and we all can feel the effects of it every time we go to the grocery store, go out to eat, or even fill the cars with gas. Everything we buy has gotten more expensive. Well, the Fed made it very clear that their mandate is to fix this. In fact, their target goal is to keep inflation at 2%. I like that. And in order to accomplish this goal, the Fed launched the most aggressive rate increases in history. And so in response to the aggressive increases in interest rates, the bond market has been doing some really interesting things. So interest rates on short-term bonds went up, and you're probably enjoying a nice 4.5% to 5.5% yield on short-term money markets and CDs. We haven't seen rates like that in 15 years, and it's a welcome sight for good savers like you. However, interest rates have stayed lower in the longer-term portion of the bond curve. Long-term rates were lower than short-term rates. You might have heard this referred to as an inverted yield curve. All it means is long-term rates are shorter than short-term rates. And so this occurs when the long-term part of the curve actually has lower rates and is suspecting that we're going to head into a recession. Because normally the long-term part of the yield curve has higher interest rates to reward you for locking in your money for longer. So with long-term rates lower than short-term rates, the bond curve was signaling that it thought the US economy was heading into a recession. However, recent economic data suggests a much healthier economy than anyone had imagined. Personal spending and consumption remains high, unemployment is low, and companies are creating jobs. The Fed has recently made it clear that the US economy is in a much better place than they initially thought, and it's stronger than anyone ever expected it to be. So their plan is to keep interest rates higher for longer. The long-term portion of the bond market is finally waking up to the fact that rates are going to remain higher, and so as a result, bond yields are increasing. People are selling the long-term treasuries, which is causing the bond yields to increase. In fact, the 10-year treasury is very close to 5%. This is great news for the bond portion of your portfolio. In fact, we haven't seen that in almost 15 years. The part of your portfolio that's positioned to do well by this is the bonds. And so the S&P 500 this year is in positive territory. However, its performance is driven by just 7 companies. So over the last 12 months, the international investments have actually outperformed the S&P 500, and we're seeing a much broader participation from that group of companies. That's a healthy sign. So the market's always going to be volatile, and this time is no different. The important thing is to keep your eyes on your long-term goals and let the markets help you accomplish them over time. And if all the negativity is getting to you, just turn off the TV or don't pay attention to that smartphone. The Fed will achieve their goal of lowering inflation, and eventually interest rates are going to stabilize. It's going to take some time, but once we get through this, it's going to be nice to be out the other side. If you want to discuss this in greater detail, please don't hesitate to reach out. We're here to take care of you.